Here are 8 things you can do to reduce capital gains when selling real estate. Number one, you have to understand what capital gains are to begin with. So they're short-term capital gains. These are for properties held less than 1 year, and that's taxed at ordinary income. Long-term capital gains are for assets held more than 1 year, and they're taxed at 0, 15%, or 20%. Small chance that it gets taxed at 0. So assume 15 or 20%. It's all based on your income level. Number two, your primary residence. So if you're selling your primary residence, there's an exclusion. So you get $250,000 for single filers, $500,000 for joint filers, off of the gains. You must have owned and lived in a home for at least 2 of the last 5 years before selling it. So you just can't move into a home, say, this is my primary home, and then a month later sell the house to get that exclusion. The exclusion can only be used once every 2 years as well. So just remember, live in the home at least 2 of the last 5 years, and you can only take this exclusion every 2 years. So for example, if you bought a house for $300,000, you sold it for $800,000, that's a $500,000 gain. If you're married and qualified, you would exclude the entire $500,000 from taxes. Number 3, use of a 1031 exchange. You can't do this on your primary home, but you can do it on a investment property. There are very strict rules. You must identify and replace the property within 45 days, and you must close on the new property within 180 days. They can only be used for investment and business properties, but the idea is that you would sell one property, you're buying another property inside 180 days. You have to have this planned out before you start the process. So don't do this after you've sold. It's almost impossible to do it at that point. Number 4, increase your cost basis. So what you paid for the home plus your improvements, like a new roof or kitchen remodel, closing costs, legal fees, title insurance. Those are all the things that you can add to the cost of the house to reduce the taxable amount. You need to keep detailed records on all these things. Number 5, offset the gains with losses. This is called tax loss harvesting. We talk about that a lot in our podcast from a stock and bond perspective, but it also applies to real estate as well. So for example, let's say you had a stock portfolio and there's been a lot of volatility in the market lately, but you sold maybe the S&P 500 index fund or a stock for a loss. And you can take that loss and apply that loss toward a real estate sale. So another real-time example of this is we use direct indexing in our larger brokerage accounts that allows us to take tax credits where normally you would not get them. And we had a client recently sell a beach property for $150,000 in capital gain. That gain was completely wiped out from the tax credits over the last few years that we used inside the brokerage account. It takes planning to be able to figure this out. So you can't do it at the last minute. But if you have a good plan in place, you are creating capital gains credits as you go along with your investments. Number 6, invest in opportunity zones. So by investing in a qualified opportunity fund, a QOF, you can defer paying capital gains until 2026, potentially reduce the amount of tax depending on the holding period. And you can also potentially eliminate all the gains if you held it for 10 years. Number 7, plan the sale for a low income year. So for example, single filers earning less than $47,000 and married couples earning less than $94,000 could pay 0% on long-term capital gains tax. So that's something to consider is maybe you're retiring and you want to sell an investment property, sell it into the year that you don't have any earned income. And then number 8 is gifting real estate to family. If you have a highly appreciated real estate, maybe holding on to that real estate is the best thing to do for your family and your legacy plan. In that case, when you pass away, there's a step up in the cost basis to what the market value is the day that you died. It allows the family to then liquidate that property with no capital gains. These are 8 things that you can do to reduce capital gains in a real estate sale. Reach out if you have questions, comment below. Thanks.